So an exit strategy can range from selling all the assets individually of a REIT, one at a time over a period of time, and returning people's capital. That would be an exit strategy. Exit meaning getting my capital back. You can sell chunks of assets. Maybe you sell a regional chunk. I'm going to sell our Houston assets, or I'm going to sell our New York assets to larger regional buyers. Maybe you sell the entire REIT to one buyer. Maybe a large international firm wants to enter in the U.S. market, and here's a way for them to purchase an aggregated amount of assets in one fell swoop, and that would be another exit strategy. Or another exit strategy would take the non-traded REIT and make it traded by having an initial public offering on an exchange. That would generally allow investors to be able to then sell their stock in a more liquid fashion. So those are some examples of a liquidity event, otherwise known as an exit event, for a non-traded REIT.
When a non-traded BDC talks or mentions an exit strategy, and generally there's a life to a non-traded BDC. BDCs generally have an equity raise cycle where they're raising capital generally 2.5 to 4.5 years, and then there's generally a seasoning period after that. So a non-traded BDC may be 6 to 8 years in that cycle. Listing would be an exit strategy. An exit strategy means that's the point in time that an investor would receive liquidity and be able to trade their security. That generally can take the form of a listing, but it can also take other forms. It can be through merger and acquisitions, or in reality, if the markets aren't right, loans have a timeline, their contracts or contractual obligations, and literally another exit event could be the runoff of those loans.